Bob Hoopshire. This is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Investors were taught a lesson in 2022 when equities and fixed income delivered double-digit negative returns. No longer could the major asset classes be counted on for diversification. That outcome has led to a surge of interest in alternative investments. My guest today will argue why alternatives are important for advisors to consider and how doing so in a cost-sensitive way is important. Hedge funds and private equity can provide significant alpha, but are often unobtainable for retail non-accredited investors. ETF structures offer advisors and their clients access to those types of investments in a liquid and transparent way. So my guest today is Bob Elliott. He is the co-founder, CEO, and chief investment officer of Unlimited. So Bob, let's start off by having you tell me about your career path. I know you worked for Bridgewater. I'm interested in any insight you can offer and what it was like behind the scenes there. But I'm also interested in the role that I know you played in the financial crisis in 2008.
Well, thanks so much for having me. It's great to be here to talk about what we're doing at Unlimited. As you mentioned, I mean, my background is about 20 years as a systematic investor. I was at Bridgewater Associates for almost 15 years, and there I built basically proprietary systematic investment strategies across basically all the major asset classes. Really got a great understanding of the hedge fund industry, as well as how to use systematic approaches to develop investment strategies, which, is really is core to what we're doing today at Unlimited. And as you mentioned, a big part of I sort of started my career about 5 years before the financial crisis, but really the financial crisis was a defining moment. And I think probably for many folks, there's those who lived through it and those who didn't, and you have very different perspectives if you lived through the financial crisis. And my role was basically to figure out led basically Bridgewater's research in figuring out, was it going to be a big deal or a small deal? Fortunately, I said big deal back then, which helped us really navigate through the financial crisis when many asset managers didn't do particularly well during that time, and also gave me an incredible opportunity to spend time counseling the Fed and the Treasury and the White House and others about how to navigate through that challenging time.
Great. So walk me through what led to the founding of Unlimited. And also you use the term systematic investing. Explain what that means.
Yeah, I mean, systematic investing, really what it means is writing down your decision rules when you're thinking about investing. And so that can be as simple as if inflation expectations rise, then I should be short bonds. It could be as simple as that. It could be as complicated as, using machine learning to infer positioning of, major hedge funds in the hedge fund industry, right? But the point is, it's differentiated. Systematic is differentiated from discretionary, where discretionary is basically human determined in real time, right? Based upon intuitions and their own sort of mental frameworks and the inputs that are coming in, versus systematic, which is intended basically not to extract the human intuition, but instead to leverage, frankly, computers are what they're good at, which is to take in data, interpret it, and bring, results of that understanding. So that's really what systemization is all about. And Unlimited, the start of Unlimited was really, I spent 15 years at Bridgewater. I actually also ran a venture capital fund, $125 million venture capital fund, which systematically identified high potential early stage consumer opportunities. And I realized my later years at Bridgewater, as well as the private side of the 2 and 20 world, that look, 2 and 20 businesses are pretty good for the manager, and not that great for the investor. And the core reason why that is because those 2 and 20 managers generate a lot of alpha, but they also charge very high fees. And so you put those two things together, and investors aren't that much better off than they would be on their own. And so that got me to thinking about whether there was a way to sort of bring the concepts of diversified low-cost indexing, which has obviously totally changed stock and bond investing, and bring that to the world of 2 and 20. Now, the issue is to do that well, what you can't invest directly in the funds because you typically would have negative selection bias. You'd have to pay the fees and then pay yourself something. So you got fees on top of fees on top of fees, right? And so our solution to that problem was, instead of trying to build portfolios of these to access these funds at very high fee rates, was to use technology to infer what those managers were doing in close to real time, take that understanding, translate it into long and short positions in liquid securities that we could package in ways that were much more accessible for the everyday investor, like ETF products. And because we're using technology, instead of like having to hire a bunch of star PMs, we can just do it at a much lower fee structure than if we were running our own LP proprietary structures.
What should the advisors who are listening to this podcast know about alternatives? And also, what do you define alternatives as? What do you include in your universe of alternatives?
I think in many ways the way to think about alternatives is there's two ways to make money in markets, right? There's beta, which is basically passively holding assets, index investing, and odds are that over time that will make money over time, because otherwise why would people invest in assets if they didn't get a better return over time than, for instance, holding it in cash? And then the other way to generate returns is through something called alpha, which is basically making bets in the market that are beyond different from index investing, that are intended to deliver returns in addition to sort of traditional index investing. And so for most investors and most allocators, if you just think about the last 15 years, it's been a great time for beta. And the reason why it's been a great time for beta is because particularly the Fed, but global central banks have been really focused on stimulating economic conditions by engaging in significant monetary stimulation and money printing. And so that's good. If their primary path was, since interest rates were already very low, was to support asset prices, then being passively invested in assets was a great opportunity. But as we've seen over the course of the last 18 months to 2 years, that dynamic has changed, right? So central banks, fearing the inflationary pressures that exist, are starting to pull back their stimulation. They're tightening. That creates a much worse set of conditions for financial assets to perform. And that's where alpha can really deliver a much more compelling value proposition, because alpha can navigate long and short, overweight and underweight areas of the market that would either benefit or be or experience a detrimental effect from this tightening process. And so that's why, actually, if you look over the last 2 years, I know a lot of people probably focus just on this year, but if you look at the last 2 years since the beginning of the tightening cycle, there's basically only three things that have done well in a mark-to-market sense, which is gold, diversified commodities, and alpha strategies.
You mentioned earlier the importance of lowering fees. That plays into a theme that I've heard discussed often about democratizing alternatives, democratizing hedge funds. What does that mean? Why is that important?
Well, I think a lot of folks, when they talk about democratization, aren't distinguishing at what cost. So there's lots of platforms. I'm sure your advisors who are listening to this are familiar with platforms like iCapital and other platforms that sort of give advisors and the everyday investor, or the investors in their book, access to alternative investments. So the problem with those is that they are giving access typically with higher fee loads and worse tax structures than even just directly investing if you're a big institutional investor, right? And so that's democratization with cost. What we're talking about at Unlimited is democratization with lower cost and lower taxes. And I think that's a really important distinction to make, because democratization is only useful to the extent that it is beneficial to your portfolio. And these alpha strategies at rack rates, frankly, aren't that compelling for the everyday investor. Just think about it. If they, if a typical hedge fund earns 10%, they charge 2 and 20, right? So that's now you're down to 6. Then the government takes half, right? Because of the tax structure of those funds. Now you're down to 3. And then your financial advisor, let's say, takes 100 basis points, and now you're down to 2. And the person's put all their money on the line, and they've gotten 200 basis points out of the 1,000 basis points of return. And the idea with using technology to replicate what these folks are doing, to do a pretty good replication, but not perfect replication of what they're doing, is we can do it in a structure that's much lower cost, right? The difference in hedge fund strategies at 95 basis points of management fee versus 2 and 20, or taxed at capital gains tax rate versus top marginal income, is the difference between these investments being a strong complement to a investor's portfolio versus ones that don't make sense to consider.
So democratization means lower fees, lower taxes. I presume it also means the elimination of the accredited investor requirement and lower minimums to gain access.
Absolutely. I was going to say, a lot of the advisors we talk to, I don't envy the challenge that they have managing a portfolio of clients, some of which are qualified, some of which are accredited, some of which are neither of those things, right? And how do you manage creating a portfolio that works for all of those investors without giving yourself too much work to try and go the paperwork and the figuring out who qualifies and who doesn't? That's the beautiful thing about an ETF structure, which is everyone qualifies. There's no paperwork. There's no K1s. It's a very efficient way to gain access to these sorts of exposures.
Let's talk about your ETF hedge fund, HFND. You've mentioned that it uses systematic investing, it uses machine learning. How does that work?
What we're trying to do with HFND is replicate the risk and return profile of the aggregate hedge fund industry, and do that at a much lower fee structure than typical 2 and 20 positions. And so the way we're doing that, the technology, saying machine learning can sound very complicated. At its core, it's a very simple intuition, which is often when you look at a manager's returns and you have a sense as to what sort of positions or assets they trade, you can infer roughly how they must be positioned, right? So if global macro did really well in the first half of 2022, and stocks went down and bonds went down and gold went up, let's say, well, then that given those are the assets that they trade, and given that they did really well, they must have been long gold, short bonds, and short stocks, right? That's the intuition, and we all do that whenever we look at a manager's returns. And really, what we're doing with our machine learning process is we're basically just doing that in a more computationally rigorous way than sort of eyeballing it and guessing. And one of the great things about looking at the returns in order to back into what is driving those returns is that because we have a time series of returns, we actually can, there's a lot more information value than might be initially apparent to folks, because, positioning is continuous. Positioning is path dependent. And so the portfolio that describes today's returns also, a marginal tweak to it has to describe yesterday's returns and the returns before that and the returns before that. And that's really where we're drawing on the machine learning approach, which is the computational rigor or horsepower to basically create the portfolios that best describe all the returns that we're seeing through time. Now, we do that at each one of the major hedge fund style strategies: equity, long, short, global macro, fixed income, et cetera. And then we just combine those on an AUM weighted basis for the HFND ETF.
So HFND is an actively managed ETF. What is the universe? Where are you getting this hedge fund data from?
Yeah, I mean, fortunately, there's actually a wealth of performance information about hedge funds that's relatively timely. Some daily information that's available, as well as the best-in-class information is available from about a half dozen different providers within a few days into the subsequent month. And so as a result, we actually have very good, rich, granular understanding on a pretty timely basis of how these managers are performing. And what we do is we look at kind of all the different hedge fund aggregators. Each one has their own nuances of what they're good at and what they're not, what they cover and what they don't. But when you look under the hood, basically every hedge fund that you've heard of reports to one or more of these major aggregator performance aggregation groups. And so that's what we're really drawing on, and then using that information information relative to the market action that we're seeing, um, and and using our, frankly, decades of experience having built these proprietary strategies to know what exposures make sense to include and which ones don't in terms of what's actually driving the returns on an ongoing basis.
Why did you choose the ETF structure versus, say, just an actively managed mutual fund, an open end fund? And I know you've also filed for some other ETF vehicles. So maybe talk a little bit about those.
Yeah, I mean, the ETF, I think, uh, for most taxable investors, is the most efficient structure, and the reason why that is that ETFs allow for the resetting of cost basis of the underlying securities using custom redemption baskets. And so, what that means practically for the investor, we go into the mechanics all day, and a good ETF nerd would love to do that. But for the investor, what you see is you basically see something that looks like a stock, right? You see a price and a dividend to some extent, some yield income that occurs. And that's exactly how it's taxed, similar to how a stock would typically be taxed. And that's really advantageous for the investor because essentially you don't likely have any of the risks of, say, big capital gains distributions, which exist in many mutual fund structures, or in an LP structure where actually you're taxed on distributions or gains, whether or not you actually take the gains in that year or not, and you're typically taxed at the top marginal tax bracket. And so, assuming that you're into those positions. And so the basic idea here is the ETF structure, it's liquid, it's transparent, it's low cost, and therefore is just the most effective structure for the everyday investor, the everyday taxable investor. And so that's really why we chose that structure. It also probably matters less for the advisor community, but it is also important from an operator's perspective that that operationally the ETF structure is actually very, very efficient to be able to do at low cost, which is why you're seeing a lot of sophisticated asset managers actually coming in and starting to issue ETFs because they see that it's a very efficient way to issue a financial product into the market. For us, we started with the HFND ETF about a little over a year ago. Frankly, wanted to see if anyone was interested in what we were up to. And in that first few months, it was actually the fastest growing independent, actively managed ETF launch of 2022. And so we talked to advisors and got their feedback. And HFND, in a lot of ways, you could think about it like as an index fund of the overall hedge fund industry. I think a lot of advisors we talked to are interested in maybe looking at some of the pieces. Maybe they have a good equity long short manager that they like, or a macro manager, or they have found, say, trend following strategies that are compelling to them, but they want to complement those with other strategies that are available, other index products. And so what we're doing is basically taking HFND and disassembling it and offering, and we intend to offer a suite of ETFs that cover those individual sub strategies that combine to actually run the HFND ETF. So it's the same technology, the same strategies. It's just packaged in a way. It's packaged in the pieces rather than in the whole.
So if I look at HFND, which I did last night, I think it owns a range of ETFs. Talk about what the holdings typically consist of. What is the expense ratio? And what do you do to ensure diversification? What is your risk management discipline?
If you just think about hedge funds in general, what are the types of assets at any size, right? They invest in public markets, right? And so at any size, what are the exposures that they have access to or that they're taking on long and short at any point in time? It's basically the 60 largest liquid markets in the world. And that's basically what our opportunity universe is at any point in time across fixed income, equity sectors, geographies, credit, commodities, and currencies, right? So we're looking at that whole universe of the biggest, most liquid assets in the world. And these managers are typically long and short those assets at any point in time. So at any point in time, you might see something like 15 or 20 meaningful size positions that are long and short across those various asset classes. And part of what we do, and it actually connects back to the ETF point, in terms of running the strategy, there was actually a relatively significant change in the underlying regulatory framework for ETFs a couple of years ago. COVID happened, and a lot of people sort of missed these changes. But basically, what it allows you to do is run much more sophisticated long and short strategies in an ETF wrapper, just as long as you implement what I'd call common sense risk controls, institutional quality risk controls, for instance, on concentration, VAR, which is just basically a total risk taking concept, leverage, both gross and net leverage constraints, things like that, things that you should be doing if you're an asset manager anyway, to run a high quality product. And so in a lot of ways, we've brought some of the institutional quality risk controls that I would be doing anyway, even if this wasn't in an ETF wrapper. And now those are in the ETF structure around those various points. And so in a lot of ways, what we're trying to do is use the technology to get exposure to those views that hedge funds have on at any point in time, and then ensure using risk controls that that we're not taking undue risk in one direction or another as part of that process.
And the expense ratio is about 1%. Am I correct?
That's right. Our expense ratio is, or our management fee is 95 basis points. And then because we implement the strategy long and short, particularly in ETF products, we have to report an acquired funds fees. The reality is actually running those ETFs long and short, because they're the most liquid markets in the world, is actually probably a little more efficient than if we bought the underlying securities for the end return for the investor. So if we bought the underlying securities, the return would be worse, but we wouldn't have to report acquired funds fees. That's a little bit of the nitpicky point. So we chose, instead of, making a worse return and making it look better, we focused on delivering the best return possible for the holders in the end. And so, yeah, we also have I think it's a 8 basis point acquired fund fee is what's reported on it.
And do you use any leverage?
We can use leverage in the form of securities borrowing, or right now we're not using any futures contracts, but that is in the prospectus, and we could plausibly use that in the future. Though that leverage, the leverage constraints in place are relatively modest. And we would intend to run the strategy at a low amount of net leverage over time, if it's appropriate. The reality is, most of the time we can get access to, we can replicate the risk return profile of the hedge fund industry in a way that doesn't use meaningful leverage on the underlying capital.
So I know it has a relatively short track record, roughly a year. Has it performed the way you expected? Has it been able to track that index?
Some people will look at this and say, well, the stocks are up, a ton, 20%, and this is up a few percent over that same time frame. And what we're trying to do with the strategy is replicate the risk return profile of the hedge fund industry, which has been very conservatively positioned over the last year. And I think that's pretty indicative of how hedge funds often navigate these challenging late cycle environments, which is that they are typically focused on capital preservation during these periods of high volatility, and then generate moderately good returns during times when all assets rise. And if you put that together, that actually, if you look at hedge funds over the last 25 years, they've delivered returns gross of fees, before fees, that are meaningfully better than stocks with half the monthly volatility and a third of the drawdowns. And so this is an indication, this gives you a good sense of that picture, which is, I think while a lot of people think that hedge funds are a bunch of hotshots trying to generate 25% returns, the reality is the industry as a whole is trying to generate a relatively consistent, 8 to 10% return over the cycle. And this is how it works, which is, conservative positioning during this sort of period. And that's why I go back to, if you start with we started in October, which was basically the bottom in stocks, the nearby bottom in stocks. If you go back since the beginning of the Fed tightening cycle, stocks and bonds are still meaningfully down, and hedge fund strategies are up gross of fees over that same time frame. And so, we think it offers, and I think a lot of our investors see the opportunity and see how it's doing exactly what it's supposed to be doing. The technology is working as we'd expect. And if anything, if we were doing a whole lot different from the returns that you're seeing, it would be indicative of the fact that our technology isn't working. So we're very happy it's doing what it's supposed to be doing, consistent with, very conservative hedge fund returns over the same time frame.
Why should advisors consider this for their clients? Those advisors who have been using it, where have you seen the allocations coming from? Where does this fit into their overall asset allocation?
Well, I think a lot of advisors are looking for alternatives in their portfolio. They all recognize, many recognize that you can't just show 60/40 on the page and paint a compelling picture for the client. And so in that search for alternative investment products, most are offering something like 10, 20, 30% of the portfolio in some form of alternative. And what we suggest is to say, hey, this is a diversified liquid alternative that you can put in your portfolio, particularly if you're if you're interested in building a strategic ETF portfolio. The idea of allocating at least some of your capital to diversified alpha strategies like this makes a lot of sense. So makes sense as one of the opportunities that are out there. And even if you're looking for individual hedge fund investments, this can be a good HFND can be used as a liquidity vehicle, right? When you have a good opportunity, you can allocate from it because of course it's got that daily liquidity, intraday liquidity, right? So you can get access to the capital quickly. And if you're redeeming or holding capital in preparation for allocating to other funds, you can hold it in HFND and not experience the sort of index drag that you would have if you just typically held it in cash and things like that. So those are the major use cases, either as a good way to get access to that, a low cost way to get access to that sort of alpha part of the portfolio, or as a liquidity vehicle allocating between individual fund allocations.
If there's one key takeaway that you'd like to leave with our audience of advisors about the diligence that they should perform on a hedge fund replication strategy such as yours, what would that be?
Well, I think there's two basic things that it comes down to. One, can you actually replicate what they're doing? And two, what are the fees? And that really, the fees really should be the focus for many advisors, because look, alpha is uncertain and fees are certain. And so if you can bring down the fees, right, your odds of having a manager who will likely outperform those fees go up. And so that's really what you should be looking for when you're thinking about these sorts of strategies: is what's the alpha, but also what's the fees, and how do you get access to the best alpha for the lowest fees available?
Well, wonderful. And we'll include some resources in the notes that accompany this podcast. There'll be a link to the Unlimited Funds homepage, a link that will allow you to follow Bob on X, formerly Twitter, and also a link to look at the performance of the ETF HFND. Bob, is there anything else you'd like to add?
No, thank you so much for having me. It was great to have this conversation.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopsher. Today, featuring Bob Elliott of the Unlimited Funds. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.